Hello, I'm Jasper Lawler, offering LCG's look ahead to the next week in markets, operating solo this time without Kelly. I'm going to discuss Trump's tax plan and bullish sentiment in markets, what new Fed Chair Jerome Powell means for the US dollar, the Bank of England's dovish hike, expectations for the next round of Brexit negotiations which start next week, life above $60 a barrel for Brent crude oil, and I also want to discuss and go through the key earnings and economic data for the week coming up. So starting with those corporate results, here are some highlights. TripAdvisor and Pirelli on Monday, Valiant Pharmaceuticals, Imperial Brands, Marriott and Snap on Tuesday, Eon, 21st Century Fox and Square on Wednesday, Siemens, Adidas, National Grid, Burberry, AstraZeneca, Macy's and Disney on Thursday. And then we finish with Allianz on Friday. Moving on to the economic calendar, on Monday it's German factory orders, Eurozone services PMI and a speech by Janet Yellen. On Tuesday, China foreign exchange reserves, the Reserve Bank of Australia rate decision and OPEC's world oil outlook. On Wednesday, Chinese trade data and the Reserve Bank of New Zealand rate decision. On Thursday, Chinese inflation. And finally, UK industrial production on Friday, when US bond markets will be closed for Veterans Day. So in terms of Trump's tax plan and what it means for the bullish sentiment in markets, I think very broadly, potentially a risk factor that we're looking at here is actually that this is a buy the rumor, sell the fact scenario. Now the tax plan is not in yet, but it's looking quite good. We've got a lot more details on it. I'm sure there are going to be some amendments, but at the core of it, we're looking at about $1 trillion in tax cuts and a 20% corporate tax rate. So at this stage, it hardly looks like the savior of the US middle class that maybe Trump would put it across as, but it's certainly good for business. And I think markets are being pretty pragmatic in their reaction. And we've not even seen some of the potential negatives that we were looking for, a sort of phasing in of the scheme or the removal of the 401k, which is like the US pension tax deduction, both of those out of the running. So overall, I think the reaction is good, but obviously we're so overbought in markets, there's a chance we sell off now that the news is almost baked in. Now, obviously we've got Jerome Powell as the next Fed chair. Trump announced that on Thursday. This was largely expected, so we actually saw a bit of a pullback in the dollar. I think part of it is just still the market pricing out Taylor, who was thought to be a much more hawkish choice. Powell, probably as far as monetary policy, is going to be the status quo. So we're looking at a continually gradual series of rate hikes in the US, and Powell is probably not going to deviate too much from Yellen on that. I think why Trump picked him and why this actually could be good for bank shares in the US, particularly US bank shares, is that he's got some private sector experience. He's a bit more pro-business, which Trump likes. And so he seems a bit more amenable, much more so than Yellen, I would say, to deregulation. So that deregulation agenda, perhaps another reason to keep markets going in the positive direction. Now, obviously, we had the Bank of England hike rates last week, but it was a dovish hike. And this was basically something we had been warning of in our special report, was that actually the Bank of England needed to do more than just hike once for sterling to go higher here. The one rate hike was basically baked in. We needed some signs from the Bank of England, from Mark Carney, that more are to come. And the general language has been about 2 more rate hikes in the next 2 years. You can't even call that gradual. That's almost nothing. We're looking at almost a one and done scenario here. Basically, the Bank of England undoing what I would argue to be a mistaken rate cut right after the Brexit negotiations. So we're looking a bit uncertain in cable. I'm generally positive on cable at the moment, but 130 is definitely a big line in the sand. If we give it 130, it does open the door to a bigger correction. Another factor that we might see affecting the pound and indeed the FTSE in a mirror image next week is the next round of Brexit negotiations. I think the risk reward here is almost skewed quite positively because there's pretty minimal expectation that anything's going to be achieved, especially after those deadlock comments from the last round. So actually maybe they can pull something out of the bag here. What you're really looking for is some sign that they've done enough on the divorce settlement to pave the way to trade If there was some clear sign of that, then I think that would be good news for sterling and 130 holds. If we don't see it, then again, perhaps looking at that bigger correction in sterling. We've seen some quite positive noises out of Merkel and Donald Tusk recently, incidentally, so maybe some source for optimism there. Let's see how it goes. And finally, I wanted to talk about the oil market. We've been holding above $60 a barrel. We saw a bit of a sell-off on the inventories data from the US because actually US exports are on the rise, but that's actually largely to do with the spread between Brent and WTI. It's quite wide at the moment, so that may be something to look out for in the weeks ahead as actually that spread tightens again as the US exports more WTI, more of its own shale oil. And so that's really the crux of the scenario at the moment, is that we've got the OPEC obviously putting out their report on Tuesday. You would expect that to be quite positive on the supply and the demand picture. And obviously we're looking ahead to later in the month with the OPEC meeting. It looks like OPEC, non-OPEC are going to extend those production cuts. And so that seems to be trumping the fact that US production is still kind of holding up at the moment. So we're seeing $65 per barrel is on the cards here. But beyond that, we start having to look at that scenario where the higher the oil price, the more encouraged US producers feel to produce more and start unwinding some of the cuts that OPEC have made into the market. Well, thank you very much for watching. Good luck with trading this week. And if you do want to see these videos as soon as they do come out, then just follow LCG on social media.